Hi, I'm Lauren. In this video, I'm going to discuss what's the best way to structure your business for taxes. Stay with me. There's no one-size-fits-all solution, and the answer depends on your unique situation. I'll break down the most common business structures and explain how each one could impact your taxes so you can make an informed decision. In general, a business can be legally formed by filing paperwork with the state that your business will be located in, probably the state that you live in. Yes, sometimes people form their businesses in other states, but for most small businesses, that's unnecessary. The documents you file will either be articles of incorporation, which will make your business a corporation or have Inc. or Corp. At the end of the name, or articles of organization, which will make your business an LLC. LLC is short for Limited Liability Company. LLCs are the most flexible legal structure. An LLC can actually report business income 5 different ways. First, an LLC can file as a sole proprietorship, which means you would be the sole owner of the business and report the business income and expenses on a separate schedule called Schedule C on your personal tax return. Second, an LLC with 2 or more owners is automatically treated as a partnership. So you and your partners would file a separate business tax return on Form 1065. The business tax return would report the income and expenses of the business, and the net income at the end of the year would be split between you and your partners at your respective ownership percentages. And that amount would be reported on your personal tax return. Partnerships don't actually pay income tax. They just report the financial activity, and the income tax is paid by the individual owners. As an oversimplified example, let's say you and your friend are 50-50 partners. If your business's net income for the year is $100,000, you would each report $50,000 on your personal tax returns. The third way LLCs can be structured for tax purposes is to be owned by one owner that is another business, basically like being a subsidiary. This structure is technically considered a disregarded entity for tax purposes. That means that the business activity of that LLC is filed on the parent company's tax return. This structure is typically used when someone wants to layer ownership of multiple entities or shift potential legal liability for an underlying asset. For example, if I owned a corporation and the corporation was the sole owner of an LLC and that LLC owned rental property, the corporation would file that rental income and expense activity on the corporation's tax return. There would be no separate tax return just for the LLC. Next, an LLC can actually file an election with the IRS to be taxed as a corporation. We use the term C Corporation just to differentiate between S Corp and C Corp, but technically a C Corp is just a regular corporation. Corporations file Form 1120 as a separate business tax return and can have unlimited number of owners or shareholders. If you want your business to be a C Corp, which you probably don't because they're subject to double taxation, you might as well just legally form it as a corporation and not an LLC. And finally, everyone's favorite small business structure is S corporations. Whether you legally form the business as an LLC or corporation, you still have to file an election with the IRS to become an S corporation. You can't just open an S corporation with your state. It's primarily just a federal tax election. So why does everyone love S corporations? They have a lot of benefits. An S Corp still files a separate business tax return on Form 1120S. You can own an S Corporation just as one individual, but they are limited to 100 shareholders. S corporations allow you to be a corporation, but avoid the double taxation like C Corps. S Corps, like partnerships, are also pass-through entities, so the net income flows to the owner's personal tax return and they pay individual income tax, not corporate income tax. So which one is right for you? Well, it depends on a lot of factors. One of the most important will be how you plan to pay yourself from your business. How much your business is expected to earn? Do you have other sources of income or a spouse with W-2 income? Do you plan on having employees besides yourself? What are your long-term business goals? And what about retirement? How much legal liability protection do you need? Your typical profitable small business will likely consider the S Corp or partnership structure, while a startup seeking investors may need the structure of a C Corp. Law firms are often limited partnerships. Realtors typically open PAs. Medical professionals tend to have LLC S Corps, and rideshare drivers are often sole proprietors. Your decision is unique to your situation. That's why it's important to understand the pros and cons of each, but most importantly, why you should consult with an attorney, accountant, or tax professional like us, who can help you make the right decision for you. Thanks for watching.